Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within company filings. Today we're diving into something a little different, a debt issuance. Let's just say Blackstone Private Credit Fund decided to raise a pretty penny, and we're going to break down what that means for them and for you. Before we go any further, if you like getting the real scoop on corporate finance without all the jargon, make sure you are subscribed. And for those who want to join a community of fellow finance enthusiasts, there is a link to our Discord server in the description below. So, what is the big news? Blackstone Private Credit Fund, a company that, well, is exactly what it sounds like. A fund focused on private credit has issued a significant amount of new debt. Specifically, they've sold $700 million worth of notes, which are basically loans from investors to the fund. These notes are set to mature in 2031, meaning they're long-term loans. They also come with a fixed interest rate of 5.350%. Now, normally when we look at these filings, we're poring over income statements and balance sheets, but this document, a Form 8K, is a bit more focused. It is an announcement of a significant event, and in this case, that event is the issuance of these new notes. Think of it like a company announcing a big new product launch or an acquisition, but instead, they're announcing a big new loan. The core of this report is about the $700 million in new notes. The fund is essentially borrowing this money from investors, and in return, they promise to pay them back with interest. This particular debt is senior unsecured, meaning that if the fund gets into trouble, the people who lent them this money will be paid back before some other creditors, but after anyone who has specific assets backing their loans to the fund. It also ranks below any debt held by the fund's subsidiaries, which is a pretty standard but important distinction in corporate finance. This part is key to understanding how risky these notes are. They are senior unsecured, which sounds good, but unsecured means there aren't any specific assets tied to this loan. So if things go south, the recovery for these note holders depends on the overall financial health of the fund above and beyond any secured debts. Also, remember those subsidiaries we mentioned. Their debts are a higher priority, meaning if the subsidiaries do poorly, that is money that won't flow up to help pay back these new notes. Now, what did the fund agree to in exchange for this money? The filing mentions covenants. Think of these as promises the fund makes to the lenders. They have to keep their assets in good shape, which is crucial for a credit fund. They also promise to keep their lenders informed, especially if they stop being a publicly reporting company. This is all about transparency and making sure the lenders have a good picture of the fund's financial stability. Here is another important detail for investors in these notes. If there is a change of control event, which basically means the ownership or management of the Blackstone Private Credit Fund fundamentally changes, they have to offer to buy back these notes at the original price plus any interest owed. This is a protection for the lenders, ensuring they don't get stuck with a debt from a company they don't trust or recognize. This whole deal was part of a larger process. They had to register their securities, essentially getting permission to sell them to the public. This involved filing a registration statement and a prospectus supplement, which are detailed documents outlining everything an investor needs to know about this debt offering. The fact that these were filed in late 2025 and early 2026 shows this was a planned and executed fundraising effort. Behind every big debt issuance, there are investment banks. In this case, we see an underwriting agreement that involves major players like Morgan Stanley, Barclays, Goldman Sachs, and others. These firms act as intermediaries, helping the fund sell these notes to investors. They take on some risk themselves, but their fee is earned by facilitating this massive transaction. So, what does this all mean? For Blackstone Private Credit Fund, this is a way to raise capital to presumably make more investments. It is a common strategy for funds like this to use borrowed money to amplify their returns. They're betting they can earn more on the money they invest than the 5.350% they're paying on this debt. Looking at the broader picture, this shows the appetite for credit products from established players like Blackstone. It also highlights the ongoing need for capital in the private credit market. These notes represent a way to get a decent yield, but it is crucial to understand the risks involved, particularly the unsecured nature of the debt and its place in the capital structure. The main takeaway here is that Blackstone Private Credit Fund is actively managing its capital structure, raising debt to fuel its operations and investments. The terms of the deal seem standard for this type of issuance, with built-in protections for lenders. However, as always, investors should do their own due diligence and understand the inherent risks of any fixed income investment, especially in a fluctuating economic environment. Alright, that is our breakdown of Blackstone Private Credit Fund's latest filing. What is your take on these debt raises and what they signal for the fund's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.